Hello, my name is Nelson Litsweni. I am a financial planner with Moedi Financial Training, and today I want to welcome you to another installment of Money Skills with Nelson Litsweni. Today we're going to handle a very interesting topic, I believe. It is how to pay off your mortgage in a record time. How to clear off your mortgage in record time. Now, before we get into that topic, it is important that we all understand that this video is for educational purposes only and should not be construed as financial advice. So if you do need financial advice, it is important that the services of a trained professional are sought and you are able to get somebody close to you who can be able to calculate and help you to implement the ideas or the concepts that we are going to be looking at into this video today. Now, mortgage is a very interesting concept in itself because the word mortgage is from the French legal term which means death pledge. Mortgage means death pledge. What does that mean? So the word mortgage, when you break it down, the word mort in French means death, and of course gage is a pledge. Engagement is a pledge. So mortgage means engagement until death. Death of what? Death of something. So when you look at mortgage, the idea is that this deal only comes to an end when either you kill the deal yourself by paying off your mortgage, or you die and the bank repossesses your home. All right? Now, obviously, there's life insurance that you can seek to make sure that should you die before you're finished, you don't lose your mortgage, you don't lose your house at all. But if death doesn't happen, then obviously it's important for you to make sure that you don't pay forever. So the idea of engagement until death, or the death pledge, it's a system that is set up to have you pay for a long time. Now think about a mortgage this way. You see, if you take 25 years to pay your mortgage, or you sign up 20 years, 25 years, or even 30 years, I mean, if you get your mortgage at the age of 30 and you take 30 years, you're going to be 60 by the time you're finished. That's a long time. So the whole idea is set up to have you paying for a very long time. So when we talk about paying off your mortgage in record time, I think most of us would like to pay attention and listen if there is any other way that you can get out of this thing very fast. It's a delay. It takes a lot of energy. It takes a lot of your resources to be focusing on paying for 20-25 years. Now, it is a long-term commitment, and it's important that you respect the fact that it is a long-term commitment. How are you going to beat a system that wants you to pay until death? That is today's question. So that by recognizing that it's a long-term commitment, you need to understand that you're not going to pay it off in 1 year or two. So you need to have a plan, and that plan must be a long-term plan, but it doesn't have to go all the way to death. It doesn't have to go all the way to 25 years or the 30 years that you signed. You can actually pay off your mortgage in 10 years or 12 years or as quickly as possible. But now, there must be a mortgage management plan that you enter into with yourself, that you are going to work with your financial planner to help you come up with the idea. I'm just going to give you the concepts over here. So the concept is this. Most people today are not permanent and pensionable anymore. Most of us, we work on a contract. So you have to look at your employment contract and say, how long am I going to be employed? Most people will have 5 years. So if you're going to be employed for 5 years and you are engaged with the bank in terms of your mortgage for 25 years, you have to ask yourself, what is the risk of my employer not renewing my contract? So if they don't renew your contract, then you have to think, what am I going to do, or how long does it take me to get another job? So then you identify that the time between when you are between jobs, those months, those are very risky months, because those are the months that you could potentially miss the installment. So now, what is the trigger point? At what point does the bank trigger the idea of foreclosure? The bank will trigger the foreclosure clause in your contract when the following happens. When you miss your installments, for most banks, 3 consecutive months of not paying your mortgage, that may trigger the foreclosure clause. Or 6 months, 3 to 6 months, you could when you miss in those periods, the bank can trigger the foreclosure clause, which means they want to kill this deal, take the house from you, give it to somebody, it is dead, right? Now, or if you don't miss for 3 months, sometimes you have arrears. You miss here, you pay, you miss there, you pay, and the cumulative number of arrears that you have, number of months, maybe 6 months, and it may be that the bank looks and say, if you have a cumulative 6 months arrears, it triggers the foreclosure clause, which means they want to repossess your house. So you need to look at that and say, how do I avoid 3 consecutive months of not paying, or how do I avoid having arrears of up to 6 months? That's where the mortgage management planning system comes into place. So you already know you are in this for a long time. Therefore, you must commit, you must write a plan, you must figure out how are you going to work with it. And the idea is this. Think about it this way. You identify the risk period. If your risk period is that 6 months, then now, while you are still employed, you must accumulate enough money to cover the risk period. So let's say your risk period is 6 months. That is, the gap between you being in between jobs is 6 months, which means right now you need to pay your mortgage as normal and also pay an additional amount to in a savings pocket that will allow you to cover the risk period. Now, most banks will help you with that. They have something called access bond. And access bond is anytime you pay extra money into your mortgage, it doesn't really go to the loan itself. It goes into a savings pocket because the bank doesn't like the idea of you disturbing that 25-year deal. You sign 25 years, they're going to stick to it. If you give them any extra money, they put it into a savings account, which is a savings pocket. Some banks call it access bond. So you'll be able to, they even encourage you to access that to go on a holiday or buy a car or something, because as far as they are concerned, they don't want you disturbing their 25-year deal with you. So you are paying extra money, but it doesn't go towards the mortgage, it's going towards a savings pocket. Now, here is how to use that savings pocket to your advantage. Keep putting money into the savings pocket, but put enough money to cover your risk period. If your risk period is 6 months, put enough money into your savings pocket to cover that risk period of 6 months, or whatever amount of time you have decided is your risk period, depending on what industry you're in and how much time it takes for you to get another job. And once you have reached your risk period, you have reached 6 months, you look at your savings pocket or your access bond, it has about 6 months or 8 months or whatever amount of time you have set aside as your risk period. You say, now I don't want any more money going to the savings pocket. Now you have to go to the bank and write them a letter or negotiate with them and say, if I pay you any more extra money, I do not want it going to the savings pocket anymore. I want it to go directly to the loan. Now you must understand, when you do that, you are changing the terms. So the bank is not just gonna okay, whatever, but it's by agreement. It's not automatic, because you will be altering the term. Now, any extra money that you have and you pay that to the bond now, your savings pocket is full, you got 6 months in there or 7 months or whatever amount of money you have in there, just leave it alone, stop putting money into that. Now take the extra money, make sure that you are taking the loan. The more money you are putting, your normal installment plus any extra attacks the loan now, because you've agreed with the bank that you want the loan to come down, and you have that savings pocket as your risk time. Now, should you lose a job, you're gonna use that risk period to cover that. But as soon as you get another job and you refill your risk period, your savings pocket back to 6 months, you continue with that until you are able to clear off your mortgage with any extra money. Now, it's very important. Some people think they are paying extra, but they don't realize that the money doesn't actually go to the loan, it goes to their savings pocket. So when you have extra money, make sure that the savings pocket equals what you want it to equal, and any extra money, take it to the capital, the loan payment for the loan itself. And as you cut down the capital, remember the capital is an amount upon which they use to calculate the interest. So if you reduce that, obviously your interest that they charge you is going to be less, and as a result, the time you are going to take, it's going to be reduced. And the more you do that, the faster you do that, it's very important for you to have a plan that you're working with. Many people make the mistake, if you have extra money and you throw it into the mortgage, you say, no, I got this extra money, let me throw it into the mortgage. You throw it into the mortgage, but it doesn't clear the mortgage, you're still at risk. Because even if you have put in, let's say your mortgage was $1 million and you put an extra 400,000 in there, and you've been paying installments 200,000, maybe there's still 300,000 left in there. I tell you, you miss 3 months, the bank will trigger the foreclosure clause. Because even if you have paid a 25 mortgage and you've paid 20 years of that, as long as you're not out of it, you miss 3 months, the bank triggers the foreclosure clause. It doesn't matter how long you have paid, okay? The bank only has 3 months memory, at most 6 months, but 3 months memory is what you have to remember that you are dealing with, regardless of your 25-year deal or 35-year deal. That is pretty much how the system is set up. The system is set up to have you paid for a very, very long time. So use your access bond, use your savings pocket to save enough money for your risk period, and then talk to the bank that any extra money that you have will be able to go directly to the mortgage. Now, if you want to do real calculations, it's important right now that you contact the services of a trained professional, a financial planner or an accountant. From there, it's just a mathematical issue to figure out how many years can you cut off of your mortgage. It's just mathematics. Your accountant can do it. Even the bank's accountant can do it for you. You can tell them, if I paid you extra, how many years can I cut off of my mortgage? As long as my savings pocket has enough money to cover all of this. So it's important that you contact the services of a trained professional to help you with this, financial planners or accountants or any money professional who knows what they are talking about. So it's also very important that you don't go after the capital before you have money in your savings pocket to cover your risk period, right? Okay, like I mentioned that already. You throw too much money towards the capital, but you don't have money to cover the risk period, and your mortgage is still running, you may be in danger of doing yourself a little bit of harm in terms of that. So now, that is what I have to say right now. If you have found this information to be helpful in any way, I'm going to ask you to look at that video and click the like button. And if you think somebody else can benefit from this information, click the share button, and you may even tag some people. And if you'd like more information about such topics as these that we are going to do in this channel, click the subscribe button and make sure that you click that little bell as well, so that you are informed when we post another video. There'll be many more interesting topics that we are going to be able to cover. Now, if you know a group or people that would like to go deeper into this teachings or this educational issues on the way we handle our money, you can send us an email at info@moedi.net, info@moedi.net, and we can be able to make contact with you and be able to help your staff or help any group that you have that can be able to benefit from such topics as this. Of course, you can link with us on our social media platforms. Facebook page is Money Skills with Nelson Litsweni. But like I said, you can send us that email at info@moedi.net. We also have a lot of books that we have published on this subject, as you can see over there, and all books are available on Amazon.com. And of course, you can also contact us at that same email address, and we'll be able to deliver these things to you. Thank you so very much. Remember to subscribe to this and share this video to as many people as you think would benefit from this information. Thank you so very much. We hope to see you very soon. Goodbye.